Welcome to the Norris Group Real Estate Podcast, a show committed to bringing you insights from thought leaders shaping the real estate industry. In each episode, we'll dive into conversations with industry experts and local insiders, all aimed at helping you thrive in an ever-changing real estate market, continuing the legacy that Bruce Norris created, sharing valuable knowledge, and empowering you on your real estate journey. Whether you're a seasoned pro or a newcomer, this is your go-to source for insider tips, market trends, and success strategies. Here's your host, Craig Evans.
The Norris Group is proud to present our 18th annual gala, I Survived Real Estate, at the Nixon Presidential Library on Friday, September 12th. Since 2008, our event has raised well over $1 million. This year, we'll be raising funds again for Make-A-Wish, OC, and IE. Individual tickets are available now. To get your tickets, go to isurviverealestate.com or click the link here in the card. We would like to thank the following platinum sponsors: UDirect IRA Services, the San Diego Creative Investors Association, Douglas Brook Homes, MBT Productions, Realty 411, and DBL Capital.
And we're going to finish out the evening with just some questions that I put a lot of thought in and trying to tie this together for everything. One, I want to thank everybody for being here tonight. I want to thank you gentlemen for putting in your time and giving your thoughts. So I'm going to ask this, and I'll let whoever wants to jump in first go. I tell you what, actually, Dan, I'll start with you just so we can have a starting. When you step back and look,
don't let Tony go first.
What's that?
Don't let Tony go first.
No, no. I'm going to put Tony on a stopwatch from now. When you step back and look at the economy, the lending, supply, policy, what do you see as the biggest risk investors are underestimating right now?
Okay, the biggest risk that investors are underestimating right now, I would say, is the need for liquidity, because as an investor, you need liquidity for two things. One, opportunity, and two, for bad things happening, right? Because, in a bad real estate market, you need liquidity. And in a good real estate market, in other words, when it's really bad and it's going to go up, you need liquidity. So I think generally 3 reasons that companies go out of business, and one of them is lack of liquidity. So I think that's something that we typically don't spend enough time thinking about.
For me, I think, is it on? Okay. I think I kind of mentioned it earlier. In the back of my mind, I still am a little concerned about what's going to happen with the economy. I still think it's going to be, growth for this year and next year, but there's a possibility that we might actually have a negative growth, in one of the quarters. I'm concerned about that negative economic growth could actually be a little bit bigger than I thought, especially if we actually have any kind of a financial meltdown in the financial market, which I don't think it's going to happen, but there are a lot of uncertainty out there right now. So that's the risk that I'm a little concerned about.
Okay.
We're in a period where prices are diverging regionally and even locally. And so I think along with the liquidity, I think a deep understanding of the markets that you're in is probably important because, like I said, you can look at Florida and Texas, prices are coming down in both of those markets. But in the upper Midwest, there's a lot of markets where prices are still strong. So you really need to know your markets.
All right. Same thing to you guys. What do you think the biggest risk investors are underestimating right now?
I'll go last.
I'll go last.
I think it's unquestionably inflation.
Okay.
I think there's no chance that a fiat currency survives. It used to be they needed to have paper. Now they don't need paper. They just widen the Excel spreadsheet and there's more currency. And so if you don't have capital assets that are income producing to protect yourself against that inflation, you are really undercutting yourself and the people you care about. I am frightened of inflation. I think it's something that people totally underestimate. I expect the government to just keep taxing people via inflation because people will not know about inflation. Go back and read the Weimar Republic and see what happened. That's an important and dangerous problem we're facing.
Okay. So there's a gentleman that has spoken in front of a fair amount of groups over the last 10 years, Christopher Thornburg. He just made a statement that he expects that interest rates on mortgages, give it 24 months to 30 months, will be 9 to 10%. So that's kind of congruent with what you're saying. So now, if that occurs, there's no math. You know, you look at a moodometer as a calculation of how much that would cost per month for you to own something with a mortgage at 9 if the prices didn't fall through the floor. So, I mean, that's really something that we haven't had to contemplate. You've had 9% interest rates, but it came at a time where you already maxed out. So it's really, you know, and that's part of what the report is going to deal with is, okay, if that occurs, what's the math of that? And, you know, there's lots of outcomes. You could have a price crash, but a lot of people have mortgages that are less than rent, and it's pretty stable. So I was just talking about this like in an hour today with another really serious investor, and I'm wondering if you don't have, let's say in California, in a boom cycle, you have 450,000 sales, and one of the things we predicted is if mortgages stay up and they don't do different types of policies like letting the mortgage go forward that's there at 2 and 3% to a new buyer, that you could have a $250,000 sales instead of 450. That has occurred. So I'm thinking, okay, you give this market a 9% mortgage rate, I'm wondering if you'll be at 120,000 sales. I don't know that you'd have tons of foreclosures, but I think you'd have, how many people could buy at this median price? Very few people. So what that means is when we made that statement, we got to meet, Doug Duncan gave me a chance to speak to the CEO of Fannie Mae for an hour and a half. And that was the discussion. If you don't let these mortgages walk to the next buyer, you basically are guaranteeing that the industry, the real estate industry, is going to be 40% unemployed. When you go from 450,000 commission checks to 250, 40% of the revenue has gone out of the industry. Yep. So if that's what's next, you got to contemplate, okay, what do we do with that? Because that could be a very big factor for revenue. You're going to have more foreclosures, but I don't know that it would fall off the cliff. I just don't.
You know, we've had high interest rates like that before and higher in the 1980s. I think that's where Peter Fortunato actually was born. And but, okay, so what happened when that happened? I mean, houses still needed to be sold and people still needed to buy, you know, so I don't remember all of the details of the 1980s because I was...
Can I fill in just some of the blanks? Okay, so you did have a run up. You had 7.5 to go, let's say interest rates about 74, go up to 15 or so.
Okay.
Okay, but there was margin, and the prices tripled during that journey.
Right, exactly.
Okay, so it didn't impact the price negatively. They kept on buying, and the volume went crazy. But then you reached that first 17% affordability, and you were done at that point, and the affordability gradually built up because interest rates went down. That was really how that happened.
Right.
But when you say you had interest rates, you weren't starting at 70% moodometer and then have an interest rate hike that goes 50% higher. That we've never absorbed.
Okay, so like for example, this year because I'm usually in small, tiny markets, you know, the Antelope Valley,
right? And
then I go up to Oregon, and I'm in Grants Pass, which is even smaller. And so I can't. And what I got into was I got into just not buying rehabs and stuff like that anymore, but I got into like just building little, you know, buying an older house, tearing it down, and building little subdivision like 11 lots and 2 to 4 units and specializing and renting to people over 50 and 60 and stuff like that. I don't want kids and dogs and all that stuff anymore as tenants. And I've had it all. I've had all kinds of tenants, but that's what I like to do nowadays. I build all one-story units. They're all for seniors, that kind of thing. But I still run across properties that I want to buy. So I decided, because we've all been talking about, like you mentioned about the generations are getting older also, because you have younger generations coming up, but then you got guys like us, right? We're sitting around with a bunch of real estate, and in Oregon, there's a lot of seniors that have a ton of real estate, and they really don't want to own it anymore. And a lot of them don't want to manage it, and they don't want to give it to property management because they get ripped off all the time and all that. So I just sent out a simple letter asking, are you interested in selling it to me and doing it to where you don't have to pay all the capital gains on because you have zero, you've depreciated the hell out of it, so you have zero basis and all that. So I get older folks that call me back up. And I go and I sit down with them, and I have a conversation. And we cut deals, and I buy their stuff, and they carry the mortgages. I don't think I have anything less than a 20-year mortgage. And I tell them I would, the interest rate that I'm going to give them is what I can afford to do, and it's usually around the 4s. And, and those deals happen. And they do it because it's a good thing for them to do. They're getting a stream of income, which is all they want. And usually their biggest thing is, I won't take a dime less than what I'm getting for rent right now. So don't try to, and I say, no, let's do the numbers and see if it'll work. And we do it to make sure that they get, I usually give them $100 more per month than what they're getting right now, and everything is great. So there's conversations that we have about the economy and big things and big numbers and stuff like that. But the real estate business, to me, has always come down to a small conversation in a small area between myself and some other folks. And as long as I can figure a way to make that work, and that's been my little thing for Glenn, in case, there's seniors everywhere, and a lot of them own real estate. You can look it up. I think you can still do that in California, where you can get information on properties and people that own them free and clear, and you can look and see how long they've had them. If they've had them for 30 years, they may be in the market for talking to you to do something like that, and they'll carry the mortgage for you. And a lot of times, like the last one I did with zero down. All I did was offer to pay the closing costs because Edith decided to carry 100% of the mortgage for me for 20 years. So, I don't know. I try not to complicate the conversation too much for myself in real estate, because if not, I get scared. And I don't want to get scared. So,
all right, so you've helped me pivot because, we started that talking about what's the risks. And as I'm sitting here, I can feel we got one side that is looking at predominantly from how do we put a deal together, how do we do this, how do we creatively finance, all of the things here, and we got financial minds that are looking at, what do the balance sheets looks like, what's the forecasting, what's interest rates. So I'm anxious to see, as we go back through, what I'd like to hear from each of you. You kind of helped start to pivot this. What do you think is the biggest overlooked opportunity over the next 2 years that investors need to be looking at? I want to make sure as these people walk out tonight, that telling stories is great. I want to make sure we've got ideas of what they need to be looking at.
Can I go first?
Absolutely.
Okay. In 2015, I'm going to interview Doug Duncan on a radio show. And so I read the Fannie Mae's financials for the fourth quarter of 2015. And as I read it, I read that one state represents 25% of Fannie Mae's losses, Florida. And I'm like, wow, how is that? And then I delve into Florida, and I find out they have a 4-year foreclosure process. They're still in 2011. So what do? I call my buddy who lives in Orlando. I said, let's buy building lots. And I'll build my rentals. So we bought the building lots for nothing because it was the product that was not desired. Right now you have a lot of builders that are having trouble, half-built houses, stuff like that. I guess I would look at optioning dirt. You and I talked about that. Because that category, first of all, that's a pretty, if it's really dirt, There's people that don't want what they have. So it's one of those categories that I like to go shopping for when no one else wants it. And you could tell me, is there a lot of people chasing project dirt or finished lots that are just sitting there?
No.
Okay. Well, that would be, that's how I think.
Yep. Good.
That is how I think.
You want to go next?
I think there's clearly a giant opportunity for people who can manage. You got older people who have properties. Tony's just talking about the properties he's seen from his friends and up in his area. And many of them have attractive financing on them or no financing on them, but they don't know how to take care of them. Their children don't know how to take care of them. The biggest estate planning problem I'm seeing in my peers is that they haven't introduced their family to the responsibility of managing the investment properties they have. So if they pass, it doesn't matter how fancy their estate plan is, if their people are afraid or don't know what payments to make or when to make it. There's an opportunity to manage for others, people who are fed up, and enable them to keep the properties and make a profit in so doing. And if you're the one who's managing it, you're first in line when the day comes they want to sell it. And I think that management is desperately needed now among a lot of people, a lot of the older people in America who have those 3% loans and have a job transfer, have to go out of state. And you heard the panel earlier, they said, are they going to keep it and rent it, or are they going to sell it? Well, most people would like to keep that 3% rate rather than go out and get new financing, and they don't know enough to go out and make some friends where they could borrow less than 7. And so those people need somebody to take care of that property in order for them to retain that property that's got the 3% encumbrance.
You gonna go again?
Well,
I'm not. I'm just going to say that, that we all have to look, we're market specific, right? So everybody's going to look at what their target markets are. What is San Diego's, that is not Grants Pass, and everything is different. But I looked at that opportunity in my market, and I actually it got my attention when I was looking at a specific building that I wanted to buy. There were actually 8 of them, and I ended up with 5 to control the association and stuff like that. But the last building I got was as a result of this older lady calling me because I sent so many letters, and it was like, "Are you the guy that's going to break my legs if I don't sell you my building?" That kind of thing. She was a joker, But we ended up having a discussion. I went to see her, and it was a really interesting conversation. And she's become a friend, and she's in her 80s, but she's sharp as a whip. She does the checkbook for her ladies' club and her church. But I found that woke me up. I started thinking, well, there's got to be, Grants Pass, it's retirement heaven. And Bruce, by the way, is the one who got me to start buying in that market. I want you to know, I was going up there for 30 years. It was the place I went to get away from real estate. And he did a class years ago when he was going to Florida, and there was a segment in the class, it was a target class, and somebody in the audience asked, "So Bruce, where are you going with your stuff?" And he goes, "Well, there's 2 markets in the United States right now that have a positive net migration." I was sitting in the back talking to somebody, not paying attention. I apologize. And Sabrina was next to me, my assistant, and Bruce says, "Well, I'm going to go," and he clicks the thing. He goes, "There's 2 markets. Number 1 is Florida." And then he looks out and he goes, "Is Tony Alvarez in this room?" And Sabrina hits me. She goes, "Hey, stupid, he's talking to you." And I said, "What?" He goes, "Are you still in Oregon?" "Yeah." "Well, hope you're buying because you're number 2. Now, the whole country, I thought it would have been Nevada, Texas, something like that. But the only reason I'm mentioning that is because the Norris Group, Bruce Norris, and the Norris Group have indeed had an impact on my life financially and otherwise. But make no mistake, if Bruce had not entered my life, my finances would not have gone to the place that they went to. And I have to say that every single time I get on a stage or I get one of these in my hand and I get in front of an audience, because it's just too important to not to say it and not to remind you guys of all the time, because we become kind of arrogant. We think we made all the money ourselves and all that. That's nonsense. And by the way, when I was ready to get out of the Antelope Valley the first time, and I went to see him, and I said, I'm done. I'm getting out of here. I went from nothing, and I got I don't want to talk into numbers. It sounds like you're bragging, right? But 10 million. I got to 10 million from zero. And I said, man, I'm out of here. And Bruce looked at me, and he went, I said, what? He goes, you better sit tight, because your market isn't over yet. I just bought some lots up in some place that I got a couple of years ago for nothing, and I'm about to start building houses. And that was a life-changing decision for me. It was in the millions of dollars that I made, and I didn't have to buy another house. I didn't have to do it. I just had to sit tight and do nothing but manage the stuff I already had.
Don't forget to visit I Survived Real Estate for tickets to the event on Friday, September 12th. The Norris Group would like to thank the following gold sponsors: Keystone CPA, the Inland Valleys Association of Realtors, Pasadena Phoebe, the North San Diego Real Estate Investors Association, LA South RIA, NorCal RIA, the Wizard of the Wobbly Box, Andy Teasley, Shepherd's Finance, the Thompson Group, Property Radar, and White House Catering. The dinner wine is provided with a generous contribution by Rick and Leanne Rossiter. Hope to see you all there.
For more information on hard money loans, trust deed investing, and upcoming events with the Norris Group, check out thenorrisgroup.com. For more information on passive investing through the DBL Capital Real Estate Investment Fund, please visit dblcapital.com.
The Norris Group originates and services loans in California and Florida under the California DRE license 01219911, Florida Mortgage Lender license 1577, and NMLS license 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the hard money tab.